DRB Homes operates as a major regional player, bringing 36 years of experience to 41 active markets across 14 states. In the Houston metro area, their footprint covers a vast price spectrum, from $239,000 entry-level builds in Magnolia to $500,000 luxury properties in Friendswood. The primary driver for their current marketing is a specific, heavily advertised promotion, an offer of up to $50,000 in flex cash for new construction homes. Large developers frequently use these upfront cash incentives to motivate buyers and move inventory quickly in competitive real estate markets. This $50,000 credit comes with specific contractual strings that bind the buyer to a precise financial path, altering the mechanics of the entire transaction. To evaluate this offer, you have to look at the captive ecosystem, a model where home builders function as their own financial institutions. This flowchart illustrates the crossroads every buyer faces. The traditional route involves securing a mortgage through an independent lender for the best rate. In the builder's preferred route, you accept the massive incentive package by financing through their captive lender. To access that $50,000, DRB requires you to use Brightland Mortgage and their approved settlement agents. Selecting a DRB home requires analyzing mortgage math and fine print requirements alongside the usual floor plans in school districts. This matrix breaks down the 5 specific ways DRB allows you to allocate that flex cash. Under Option 1, you apply the funds toward your actual closing costs. This provides a transaction with near zero out-of-pocket fees at the closing table, allowing you to keep your personal cash in the bank. The trade-off for this immediate relief is the loss of mortgage optionality on the open market. If a local credit union or an online broker offers a lower base interest rate than Brightland Mortgage, the incentive loses some of its value. The upfront cash relief must mathematically outweigh the potentially higher lifetime interest costs of using the builder's captive lender. Option 2 shifts the focus toward the design center, applying the flex cash to interior upgrades. This allows you to select premium finishes without needing to bring extra cash to the closing. However, the fine print reveals that certain premium design choices may trigger a requirement for an increased out-of-pocket deposit upfront. You are also strictly limited to DRB's specific pre-selected design catalog and configurations. Ultimately, these design credits function as a highly controlled expenditure, limited by a specific catalog and potential upfront risks. Options 3 and 4 involve permanent or temporary interest rate buydowns. In this chart, you can see how paying points permanently lowers the monthly mortgage payment for the entire life of the loan. Purchasing points is expensive and can consume the $50,000 maximum rapidly, leaving little capital for other closing costs. Option 5 applies the flex cash as a direct reduction to the total price of the home. In Texas, a lower base price offers the secondary benefit of reducing the property's assessed value, which lowers your annual property taxes. A lower base price provides significantly less immediate monthly cash flow relief compared to a subsidized rate buydown. You should model these specific options against each other with a financial advisor to find your exact break-even point. Qualifying for the incentive requires staying within rigid promotional windows, such as signing a contract between June 1st and July 31st. These tight deadlines often push buyers toward purchasing quick move-in inventory homes, rather than building entirely from scratch. Securing the cash on a fast timeline means you might forfeit the ability to choose your ideal lot or make any structural floor plan choices. There is also a strict use it or lose it clause. If your selected options do not equal the full $50,000, the remaining balance disappears and cannot be redeemed for cash. Strategically allocating every single dollar of that maximum incentive is the only way to ensure you aren't leaving money on the table. This quadrant chart maps out exactly who benefits most from the DRB ecosystem and the $50,000 incentive. The ideal match sits in this quadrant, the capital poor but income-stable buyer, typically a first-time homeowner. Using DRB's captive ecosystem entirely removes the immediate cash barrier to entry for these buyers. All cash buyers, or those with highly competitive outside financing, like specialized VA loans, should generally avoid the ecosystem if their outside rates beat the $50,000 subsidy. Treat the $50,000 flex cash as a specialized financing tool rather than a standard discount, and always demand an independent lender check the math before signing the contract.